This lecture is about what happens in a partnership business when there is a change in profit sharing ratio, especially the treatment of goodwill when there is change in profit sharing ratio. The outline of the lecture is as follows. Change in profit sharing ratio, brief introduction, preparing goodwill account, which is written off instantly, accounting for goodwill directly in the partner's capital account, and this is a situation where no goodwill account is prepared, and then illustrated example. This illustrated example will be worked out and answered. It is covering all the content of the lecture, explaining the various concepts that shall be covered within this particular lecture. To start with, change in profit sharing ratio. If the partners decide to change their profit sharing ratio, what happens is that at that point that the change takes place, some partners are gaining in profit sharing ratio, while others are losing in profit sharing ratio. Because of that, some adjustments have to be made. Then these adjustments, the main reason why they are made is that the gaining partners compensate the sacrificing partners or the partners who are losing on profit sharing ratio due to that particular change. So a number of adjustments need to be made. One of those adjustments is goodwill. So we shall focus on goodwill, or what happens to goodwill or treatment of goodwill on change in profit sharing ratio in a partnership. An adjustment is required in terms of goodwill. That adjustment, its main purpose is to compensate the sacrificing partner, the partner who is losing profit sharing ratio, and then share the value that has been created in the business before such a change occurs. Realize that if a business has been existing, the existing partners may have created some value, and that value in terms of goodwill need to be shared among the partners before then they have a change, because such a change will affect the sharing of that value in future. So before that change takes place, the partners decides to share the value that has been created so that each partner benefits based on the existing profit sharing ratio and based on the contribution that they have made in the business up to that particular point before the change takes place. The goodwill is then considered in the books of accounts of the business. It can be done in two ways. The first one, or the first case, is that goodwill is created in the books of account of the partnership at the entire value, but then is written off instantly. In this case, where goodwill is written off instantly, then goodwill is created by crediting all partners in their existing profit sharing ratio, and then that goodwill is then written off in the new profit sharing ratio. By creating goodwill or by crediting goodwill in the existing profit sharing ratio, they are sharing the value which has been created. Then by writing it off in the new profit sharing ratio, they are recognizing what will happen in the future, because some partners have lost profit sharing ratio, others have gained. So the writing off is meant to compensate the partners who have lost in profit sharing ratio by transferring some value from the partners who have gained in profit sharing ratio. Some partners are losing goodwill to compensate the partners who are losing profit sharing ratio. The following entries therefore need to be made to really create goodwill. Now, to create goodwill, debit goodwill account with the entire value of the goodwill. Then to all partners account, credit with the share of goodwill based on the existing profit sharing ratio of the partners. Then what follows is writing off of goodwill. Goodwill is written off in the account of all partners who are existing in that business using the new profit sharing ratio. Therefore, all partners' capital account will be debited with their share of goodwill based on the new profit sharing ratio. And then to the goodwill account, credit the entire value of goodwill. The goodwill which was created is now written off by crediting. That is the first scenario where goodwill account is created but then written off. The second scenario is where adjustments are to be made devoid of opening goodwill account, meaning there is no opening of a goodwill account. In this second case, the adjustments for goodwill is to be created through the partner's capital account directly without having to create a goodwill account. The account of a partner will be debited if the partner makes a gain in his right of goodwill. And then if a partner, the account of a partner will be credited if the partner forego his right of goodwill. That is now in the case where we are talking about the new profit sharing ratio. That is done through the following entry. To create goodwill directly the partner's capital account is for the gaining partner's capital account, debit the account, and for the foregoing partners, credit their capital account. The following example illustrates the concepts that have been explained in this lecture from the beginning. Fred, Joyce, and Dorothy are partners in a trading firm and share profits and losses in the ratio of 3 to 3 to 2. On 31st December 2020, they wanted to change the profit sharing ratio to 1 to 1 to 1. The goodwill is revalued at 9 million. The firm's statement of financial position on 31st December 2020 was as follows. Goodwill, 1 million. Other assets, 79 million. Capital accounts for Fred, Joyce, and Dorothy, 30 million, 30 million, and 20 million, respectively. Required. Prepare the partner's capital account and statement of financial position immediately after the change. There are two approaches to the answer of this question. The first approach is a situation where goodwill account is prepared. Even though goodwill account is prepared, goodwill is written off from the books of accounts immediately or instantly after the change has taken place. The second approach is where goodwill is accounted for directly in the partner's capital account without creating goodwill account. Let us begin with the first approach. If goodwill account is to be created, then goodwill is debited in goodwill account, beginning with the balance brought down, which is equal to 1 million. As you can see, balance brought down for goodwill is 1 million. Then, when the change is taking place, goodwill was revalued at 9 million. That is to mean the value of goodwill has increased from 1 million to 9 million. Increase in goodwill is 8 million. That increase in goodwill of 8 million is shared among the existing partners in the old profit sharing ratio of 3 to 3 to 2. Total ratio is 8. That therefore means 8 million will be shared among Fred, Joyce, and Dorothy as follows. Fred, 3 million of the increase in goodwill. Joyce, 3 million of the increase in goodwill. And Dorothy, 2 million of the increase in goodwill. And to determine these values is that we have multiplied 3 over 8 by increase in goodwill, which is 8 million. 3 over 8 by increase in goodwill, which is 8 million. And then 2 over 8 by 8 million. To determine the share of goodwill that each partner will receive. That increase in the value of goodwill is then transferred to the partner's capital account as follows. Fred, Joyce, and Dorothy. Fred, Joyce, and Dorothy. Right. Begin with the balance brought down of capital, which is 30 million for Fred, 30 million for Joyce, and 20 million for Dorothy. Then record the goodwill increase. Share of increase in goodwill is 3 million for Fred, 3 million for Joyce, 2 million for Dorothy. After recording goodwill as that, then goodwill is written off immediately. To write off goodwill, the following entries need to be made. In goodwill account, goodwill will be credited and then debited in the partner's capital account. But then what is it that we are debiting or crediting? The total value of goodwill. The total value of goodwill is 9 million. So that 9 million will be credited in goodwill account. But then as it is being credited in the goodwill account, it's being written off in the partner's capital account. So goodwill is written off in the partner's capital account. To write off goodwill in the partner's capital account, goodwill is written off in the new profit sharing ratio. And the amount of goodwill to be written off is the total amount of goodwill, which is 9 million. To write off 9 million among the three partners in the new profit sharing ratio, which is 1 to 1 to 1, that is to mean goodwill is written off equally among the partners. The partners are 3, and therefore goodwill is written off as 3 million, 3 million, 3 million to make a total 9 million. Therefore, in goodwill account, we have capital account of Fred, Joyce, and Dorothy to be 3 million each. So that the total will be 9 million. 9 million. That is how to write off goodwill. Then in the partner's capital account, 3 million is entered for each partner to write off goodwill. So goodwill has been written off. This is a double entry of the credit made in the goodwill account. After that, balance of the partner's capital account, so that we have balance carried down as 30 million, 30 million, and 19 million. The total here is 33 million, 33 million, and 22 million. $33 million, 33 million, 22 million. That is how to prepare the partner's capital account and the goodwill account. This information is then posted or transferred to prepare the statement of financial position. This information is then transferred to prepare the statement of financial position. And in the statement of financial position, the information will be as follows. Beginning with other assets. Goodwill has been written off, and therefore goodwill will not appear in the statement of financial position. The other assets are a total of 79 million. This is financed by capital accounts of the partners for Fred, Joyce, and Dorothy. Capital accounts of the partners, the balances carried down here are balances of 30 million, 30 million, and 19 million. Total of financing is 79 million, which is equal to the total value of assets of the partnership at that point. The second approach to the answer of this question is a situation where there is no goodwill account opened. In this case, goodwill is accounted for directly in the partner's capital account. Right. We therefore start with the capital balances brought down at the beginning or before the change takes place. Balance brought down for the partners: Fred, 30 million, Joyce, 30 million, Dorothy, 20 million. After that, we record the goodwill. And to record goodwill, we record only increase in goodwill. Before the change takes place, goodwill of the partnership is 1 million. But then at the point of change, goodwill was revalued to be 9 million. That means there was an increase of 8 million in goodwill. That increase of 8 million in goodwill is shared among the partners in their profit sharing ratio. Partners are sharing profits in the ratio of 3 to 3 to 2. Because of that, the total ratio is 8. Therefore, to share goodwill among the partners, therefore, Fred will have a share of 3 million, Joyce a share of 3 million, and Dorothy a share of 2 million. Then after recording goodwill as that, goodwill is written off. To write off goodwill and to show the effect of the change, then that goodwill is written off as follows. We are writing off goodwill in the new profit sharing ratio, and the goodwill to be written off is the total goodwill, which is 9 million. Therefore, 9 million will be shared among the 3 partners in the new profit sharing ratio. The new profit sharing ratio is the ratio of 1 to 1 to 1. That means the 3 partners share goodwill equally. 3 million, 3 million, and 3 million. After sharing goodwill equally in the ratio of 3 million, balance of the account of the partners. And therefore, we have balance carried down. And the balance carried down of the partners, equal to 30 million, 30 million, and 19 million. After the balance carried down, then we get the total for each column: 33 million, 33 million, 22 million, 33 million, 33 million, and 22 million. In the statement of financial position, therefore, goodwill will not be shown because goodwill has been written off. Therefore, the assets of the partnership that are supposed to be shown in the statement of financial position are the other assets other than goodwill. And those assets other than goodwill equal to 79 million, sorry, is equal to 79 million. That is the total assets, and that is financed by capital accounts, for Fred, Joyce, and Dorothy. The balances of capital accounts for the partners are as shown here: 30 million, 30 million, and 19 million. Therefore, we have 30 million, 30 million, and 19 million. So that the total will be equal to the total of the assets, 79 million.